Hey guys, thanks for taking a minute to join with me. I'm going to go through and we're going to do a tax return together. Now, in that I'm an accountant, I can't show you everybody's financial information and all that fun stuff, but I can talk you through it. So let me just kind of give you an update on what we're doing. We're doing a company, they're a C corporation. Now, I say that's kind of an accounting term or a tax term. That means that they are a corporation who pays their own taxes. So a lot of people are S corps, which means that you file that return and then that income goes through on a K1 onto your personal return or onto all the owner's personal returns. This one does not go through to the personal return. They pay their own taxes. Now, historically, the tax rates were progressive, but now they're a flat rate. They've been a flat rate for quite a while now. So they pay at 21%. So if a C corporation makes $1,000, they're going to pay $210 to the federal government. States are all a little different. But C corporations do have some advantages. All right, you can have different types of ownership. You can have different types of stock. A lot of publicly traded companies have to be that if there's over a certain amount of owners. So there's a lot of rules to them. They're not super common anymore. They used to be much more common. But this particular entity is a C corporation. So we're going to go ahead. We're going to file it. I'm just going to talk you through what I do. So when I go to do a corporate tax return, how I started off is that you like to get a copy of the balance sheet, which is sitting right here. And I go through and I just go right down the balance sheet and try to make sure it's correct. So if you know that you have a correct balance sheet, that means that all the information is there. It's all somewhere that it's supposed to be, right? That means that your assets are right, your liabilities are right, and your equity is right. That your profit and loss statement will have all the information. Now, it may not be, maybe your sales weren't categorized correctly, or maybe your expenses weren't categorized correctly, but at least it's all there and we can be confident in that. So if we start with the balance sheet, I just work my way right down. I go to the checking accounts. So I say, all right, this particular company has an operating account. So I go through and I find the operating account statement. I always request these things along with the reconciliation. So you want to make sure that the reconciliation is done so that you know you've got all the transactions there. And you know that if there's a difference between your accounting software and your bank account, you can explain what that difference is. In this case, they have some outstanding checks. So we go through and we say, yep, there's the reconciliation. I check the outstanding checks and say, is there anything in there that I should be pulling out or reversing because they're getting kind of old? In a previous year for them, I had reversed a couple of old transactions because they had been there for over a year. I worked for a guy who used to do it 6 months. We would reverse them. I worked for people who said, I'm just going to ask the client, hey, should I reverse these things? I like to ask the client and say, hey, you got these old transactions. Do you think they're actually going to clear or not? Or should we go ahead and reverse them? Now I'm doing several years of returns for this person, and I looked and said, oh, these have not cleared in about 5 years. So we go through and I say, yep, that is. So I just check it off and I put it back. I put the papers behind the balance sheet and I mark off on the papers and say, yep, there it is, so that I can verify that it's been looked at. And then I go down and now there's accounts receivable. So I look at the accounts receivable to see were they paid. So when you're substantially after the fact, and in this case, we're 5 years after the fact, I say, was this paid? And then, yes, all of these were paid. So I am okay with those accounts receivables. Inventory assets, so they do have some inventory. I'm going to believe them on that number because it's a little hard to go back that far and read it. Security deposit, we talked about that. And sometimes, so a security deposit is you pay something that isn't being used, but it's like for rent, right? So you have to rent an office space. They may require you to do a security deposit on that. It's more common in apartments. This particular one is utility. So if you open up a utility account and it's new, usually they will require you to put down a deposit. And then at the, after 6 months or 12 months or 2 years or whatever their time frame is, they'll go ahead and apply that against your bill. And that's when you'll reverse it. Because this is an accrual-based taxpayer, meaning that they have to pay taxes when they bill somebody, not when they're necessarily paid. They also have to pay when they actually incur the expense. So they haven't incurred that expense yet, meaning that they're going to have to just call that an asset until it's used. Then we go down, they had accounts payable. I saw that most of those had gotten paid, so we're good with that. She did say that she still owes whatever it was that was left. And then a loan. Now, this is a shareholder loan. So you can have different types of loans. Now, C corporations often have shareholder loans. This particular one is she had lent money into the business in order to keep the operations going, and the business is supposed to pay her back over time. And then we look at the equity to see, okay, was there any equity transactions? In C corporations, we generally don't see a lot of equity transactions because they would either be contributions or dividends. Dividends are taxable on your personal account as investment income. So usually people run it through their shareholder loan account but you have to be able to have a reasonable explanation for it. And if it's not going to run through a shareholder loan account, we'd rather see it go through wages usually, just because then you're avoiding the double taxation. So C corporations have double taxation, meaning that any profits, you're going to pay that 21% on, and then any dividends, you have to pay at your personal rate on. Most people are, around 10%. So you could actually be paying 31% taxes on that, which is why we generally don't see a lot of dividends. Now you'll go and be like, well, Verizon and all of them do dividends. Yes, and they also get to pay those taxes, but that's a very different type of investment than a really small corporation like this one. So after we go through and we say, okay, I've got my balance sheet all good, I've already run through it, I will then go ahead and I'll take a look at the profit and loss statement. And now I will have my accounting software up. So I do have my accounting software up in front of me. I'll go through to make sure everything's kind of categorized correctly. I also like to run a previous period report, meaning that I can see what was in the previous year. So in this case, I'm going to look at the 2019 and the 2020 profit and loss statement. So I can just see, are there any major changes? So if there's a major change in there into sales or in some sort of expense, I'll look at it to see if something miscategorized. Oftentimes, that's an easy way to catch miscategorizations. And then lastly, I've already done this. I will go through and I'll look at the W-2 information, so the wages that were paid. Were their wages paid and does it match? So the IRS likes to look at that and say, okay, does this match what was reported to us? And Social Security also got that. And we want to make sure all of those tie together. Because the IRS sees that and will follow and make sure that it is correct, I always try to check that one specifically, where something like cost of goods sold or advertising or promotion, the IRS doesn't have, right? So I don't have to know that, oh, yeah, this is exactly what was reported to them. I just look at it to say, does this seem about right? Yes. So I know my balance sheet's right. I know my profit and loss statement's right. I'm then ready to go ahead and start putting it into the tax return. Now, in this case, they have a loss for the year, so they're not going to owe anything. Now, on an S corporation, a loss would go through to your personal return and offset other income if you have it. In this case, because it's a C corporation, this loss will then be carried forward onto the next year's tax returns. So eventually, hopefully, this corporation turns a profit and we'll be able to start consuming those losses. Losses on a C corporation, though, you do not get 100% in that year. You can only take up to 90%, I believe. So if you did have, let's say she had, $10,000 and she had a $10,000 of profit, and then she had a $10,000 loss carry forward, well, she'd only be able to take $9,000, which means she'd still have that $1,000 taxable income. So now that I've got that all ready, I've already done all the background work. I've made sure everything's correct. I'm happy with the financial statements. I will then go through and go to my tax software and start inputting everything in. When you're inputting everything in, what you do is you just cross it off. So I just go through and I say, okay, did I put the cash balance? Did I put the accounts receivables? Did I put the payables? Did I go through and put everything in correctly? At the end of it, after everything's in, what I'll do is I'll go through and say, okay, does my profit and loss match my net income on the books? Now, it doesn't always match the net income on the books, because there could be things that are expensable or fully expensable on the books that are not on the tax return. The number one of all that is meals and entertainment, right? You get 50% of meals and entertainment. But there could be, if you're doing GAAP-based financials or something, other differences that you'll need to go through and reconcile to make sure that you have all of your information in correctly. Now, if she had turned a profit, we might have a talk about, should you have bought any assets? If this was more timely, like right about now, we would start talking to companies about 2025 to say, okay, you look like you're going to turn a profit. Are you going to buy some assets? Do you have any tax credits that we could maybe take for you? And start looking for ways in order to get that tax liability down as much as possible. In a C corporation, there are, just as many things that you can do as an S corporation. So we really try to pay attention to that beforehand. When you're doing it a couple years after, a little hard to buy an asset, a little hard to do anything. Lucky for them, they had a loss, or not lucky for them, I'm not sure. But hey, thank you for joining me. I hope this was a little bit helpful if you're trying to file a C corporate tax return. If you have any questions, feel free to reach out to me. I'd love to talk to you.